Ethereum is dying. At least, that's the narrative dominating social media right now. Price action feels stagnant, transaction fees look uncompetitive, retail capital is chasing speed, and fleeing toward chains like Solana in search of the next meme coin cycle. From the outside, Ethereum looks slow, expensive, left behind. But here is the uncomfortable truth. The boredom you're feeling is not a sign of failure. It may be the signal that Ethereum is no longer competing for speculation, but positioning itself for something far larger. While retail focuses on short-term candles, the largest financial institutions in the world are quietly making infrastructure decisions that last decades. And once you understand what they are optimizing for and why, you begin to realize something critical. Ethereum's current stagnation may not be weakness. It may be the early phase of a structural transition that the market has not yet learned how to price. Hi everyone, you're watching Global Macro and Crypto. Today, we are dismantling the thesis of Ethereum as the digital bond of the internet, and why this evolution is the only move that matters for institutional capital in the coming years. To understand Ethereum's position today, we need to confront a massive market illusion. On the surface, it looks like Ethereum is losing. Solana is faster, cheaper, smoother. The user experience feels closer to a modern fintech app than a decentralized network. And in speculative cycles, user experience attracts attention. Attention attracts liquidity, and liquidity attracts narratives. But markets have a habit of distracting investors with the wrong scoreboard, because while retail is focused on speed, institutional capital is focused on certainty. And those are not the same game. Here is the mistake most investors make. They assume the chain with the best user interface will capture the most value. History suggests the opposite. The internet did not scale on the flashiest companies. It scaled on the most reliable infrastructure. And in financial markets, reliability is not a feature. It is survival. Let's make this tangible. Think of Solana as a Formula One car, engineered for extreme performance. When conditions are perfect, nothing feels faster, nothing feels more exciting, but high-performance systems carry structural fragility. A single mechanical failure ends the race. We have already seen network outages. For a meme coin trader, downtime is frustrating. For a trillion-dollar asset manager, it is career-ending risk. No CIO wants to explain to an investment committee that billions of dollars were locked inside a network that temporarily stopped producing blocks. Institutions do not optimize for adrenaline. They optimize for permanence. Now, contrast that with Ethereum. Ethereum is not trying to be the fastest machine on the track. It is trying to become the settlement layer of the digital economy. Think less Formula One and more transcontinental railroad. Slower? Yes. More expensive? Often. But it does not stop. And when global capital moves, it does not ask for speed first. It asks one question. Will this transaction still be final 10 years from now? This is the concept of settlement assurance, and it is quietly becoming the most valuable property in crypto. Very few retail investors price this in, but every institution does. And once you see this shift, you cannot unsee it, because suddenly, the conversation is no longer about which chain feels better. It becomes about which chain the financial system is willing to trust. Let's pause for a moment, because if you remember only one idea from this entire video, it's this. Crypto markets are not one game. Retail participants compete on speed, hype, and timing. Institutional capital competes on certainty, durability, and settlement assurance. And those two groups do not reward the same networks. What looks boring to a trader can look essential to a balance sheet. What feels slow to a retail user can feel permanent to a CIO. And this distinction is the key to understanding why Ethereum's current phase is being so widely misunderstood. Because the question is no longer which chain feels better to use today. It is which chain global capital will still trust 10 years from now. Now consider what may be the loudest signal the market is still underreacting to: BlackRock. When Larry Fink's firm launched the BUIDL fund on Ethereum, it was not experimentation, it was positioning. BlackRock manages trillions. Organizations of that scale do not make infrastructure decisions casually. Before deploying capital, they stress test governance, regulatory posture, security history, validator distribution, and attack resistance, months of diligence, teams of analysts, external audits. So, when they chose Ethereum, the message was not subtle. This is the foundation we are comfortable building on. And here is where many investors make a fatal miscalculation. They think institutional adoption will look dramatic. It rarely does. It looks quiet, gradual, almost boring. Until one day you realize the rails of a new financial system were installed, while everyone was watching price charts. What we are witnessing is not hype-driven adoption. It is infrastructure-level migration. Ethereum is undergoing a metamorphosis, from speculative technology to productive financial asset. Let me explain why that matters. When you stake ETH, you are no longer just holding an asset and hoping someone pays more later. You are participating in network security, and in exchange, you receive yield derived from real economic activity, transaction fees, and MEV. Pause for a moment and consider how radical that is. For the first time, a globally accessible asset offers commodity-like utility, bond-like yield, monetary scarcity, all inside a single instrument. There is no clean analog in traditional finance. Some analysts call this a triple-point asset, and the market still does not fully understand how to value it. Here is a question worth asking. What happens when the world realizes that one of the most secure financial infrastructures ever created also generates yield? Because yield changes investor behavior dramatically. Look at the current supply dynamics. Over 30% of all ETH is already locked in staking. Think about that. Nearly 1 out of every 3 coins is effectively removed from liquid circulation. Now, imagine what happens as pension funds, sovereign allocators, and insurance balance sheets begin seeking digital yield. They are not buying ETH to trade volatility. They buy and they hold. While retail exits out of boredom, structural buyers absorb supply. This is how silent supply shocks form, not with headlines, but with slow, persistent accumulation. And just as this tightening begins, another force compounds the effect. EIP 1559. Every time network demand rises, a portion of ETH is permanently burned, destroyed, removed from existence. So, step back and look at the structure forming beneath the surface. Demand potentially rising, liquid supply compressing, new issuance partially offset by burn. Ask yourself honestly, does that sound like a dying asset or one being engineered for scarcity? Yet no serious macro thesis is complete without addressing risk. And yes, risks exist. The growth of large staking entities introduces concentration concerns. If too much validation power aggregates under a few operators, the very settlement assurance institution's value could weaken. Markets are watching this closely, as so are regulators. Speaking of regulation, this remains the variable capable of reshaping capital flows overnight. If staking were aggressively classified as a securities activity in major jurisdictions, institutional participation could slow. But notice the direction of travel. Spot ETFs approved, custody frameworks maturing, compliance pathways forming. This is not what regulatory hostility looks like. It looks more like reluctant acceptance. Now, let's confront the question many investors are quietly asking. What if Ethereum stays boring, while faster chains capture the spotlight? Here is where second-order thinking becomes critical. Ethereum may no longer be competing for the retail interface. It is moving up the stack. Layer 2 networks handle speed. Applications handle user experience. Ethereum handles truth. Every transaction settling from networks like Arbitrum or Base ultimately inherits Ethereum's security. So even when users never touch mainnet, they are still consuming Ethereum block space. The base layer does not need to win the popularity contest. It only needs to remain indispensable. And infrastructure that becomes indispensable tends to accumulate value in ways the market recognizes late, much later. So, zooming out, Ethereum's stagnation may not be a warning sign. It may be consolidation, ahead of institutional scale. Beneath the surface, the system is hardening, supply is tightening, and credible players are committing quietly. The fastest horse rarely carries the most capital. The most trusted one does. This is why serious investors think in probabilities, not certainties. If Ethereum continues attracting real-world asset tokenization, if staking participation keeps rising, and if Layer 2 ecosystems successfully route value back to the base layer, its role as the digital bond of the internet becomes increasingly difficult to challenge. But if centralization risks accelerate, or if economic activity fragments away from Ethereum, repricing is possible. Conviction without risk awareness is not strategy, it's speculation. So the real danger in this cycle may not be volatility. It may be abandoning a structurally strengthening asset simply because it feels boring. Financial history is filled with fortunes built on assets that looked uneventful right before they repriced. In the next video, I will explain why XRP is falling while institutions are quietly accumulating, and why relying on price alone may cause retail investors to miss what the smart money is actually positioning for. Thanks for watching Global Macro and Crypto. I will see you in the next one. If this added clarity to your perspective, hit like and subscribe. Now, let me ask you this. Will Solana dominate the user layer while Ethereum quietly becomes the financial backbone of the internet? Or is the market still misunderstanding what actually matters? Leave your view in the comments below. This content is for educational purposes only and does not constitute financial or investment advice. Always do your own research.